Focus. Ideate. Innovate. Enable. Bank of Baroda presents The Future of Banking, powered by CNBCTV-18.
Hello and welcome to this special series, The Future of Banking, powered by Bank of Baroda and CNBCTV-18. I am being joined by Mr. Sanjiv Chadha, Managing Director and CEO of Bank of Baroda. Mr. Chadha, thank you very much indeed for joining us. Well, banking is, the sector for all seasons, so it's always a pleasure speaking to a banker. My first question really is the problem that is upon the world, the Ukraine war. Do you sense any problem at all for banking sector in India or Bank of Baroda in terms of exposure to companies that may have exposure to Russia?
So I think for the banking industry, probably as a whole, and particularly for us, the exposures are very limited on Russia. So to that extent, I think any direct impact has to be very, very minimal. Having said that, to the extent that the global macros are impacted, to the extent that any challenges we had in terms of supply bottlenecks get accentuated, the impact would be there. But then that would be a second order impact. In terms of a direct impact, very minimal.
Okay. Well, be that as it may, we have seen the Nifty Bank take a beating in the immediate aftermath after the war started. In fact, banks everywhere, in other countries also, bank stocks fell. That is why this question. I mean, are we affected in any way?
So to my mind, not really. Probably again, we can talk in terms of what might be the impact of rising rates, inflation. But here also, to my mind, we are in a good place. So we looked at the data of some 1789 companies that BOB has, and to see where do we stand, say, vis-a-vis 4 or 5 years back when there might have been other occasions of perceived vulnerability. So what we find is about 5 years back, about 50% of companies had interest coverage ratios of less than 3 times. Today, that percentage has come down to 20%. Within that, interest coverage ratio of less than 1 was 10%. Today, it's under 3%. So I think there's been a secular deleveraging of balance sheets that's happened. The impact of any increase in interest rate, to my mind, should again be marginal going forward. And all told, we probably are looking at normalization of rates. And to that extent, I think it should be well absorbed by the companies and the economy.
Okay. Well, I would assume that globally, perhaps there could be NPA creation, but we are in a different and a sweet spot, perhaps. Let me come to the growth question itself. We started off the year in January and even during the budget, expecting, a 7.8% GDP growth. Credit growth was picking up. Is there any halting of the pace?
So I think there will be an impact on the margins again. So we were projecting in BOB a growth rate of 7.75 to 8%. That has been revised marginally down to 7.5 to 7.75. Okay. I think largely because in terms of growth, the heavy lifting this year again was to come from the government. The budget again had looked at elevated levels of expenditure. I don't believe that is likely to change. There was enough buffer which was there in the budget. If you're looking at inflation being slightly elevated, even then nominal growth rates, which in any case possibly were higher than the budget projections, I think they should make up for that. So the revenue capacity of the government and the capacity to spend, to my mind, even if we allow again that there may be some absorption by way of excise duty of elevated oil prices, still should be intact. And therefore, if we believe that the role of the government is still primary, the corporate investment cycle is picking up, I think to say that we will not be in a very different place as compared to what we were 2 months back, I think should be fair.
Okay. No, actually, speaking of 2 months back, you all posted excellent results, better than what the street expected. And your credit growth came primarily from retail. You had an 11.1% retail growth, even if the overall YOY growth was not very impressive. Retail was very good. Are you worried that there might be any, slowdown, especially rural? Because we hear of rural pain, and then if the petrol prices, diesel prices get passed on, will you still be able to generate that kind of growth?
So I would believe so. I think in terms of challenge when it comes to growth, it has been more in terms of pricing power for banks, particularly on the corporate side, which is why we elected to grow faster on retail, because that made more sense at that point in time. Yes. Now, if we again return back to your first question in terms of possible impact of tightening of liquidity, of interest rates going up, you might argue that there's a possibility that some pricing power returns as far as corporate lending also goes. Therefore, if we were to believe that there may be a marginal impact on the retail side or on agriculture, I think the return of pricing power because of the normalization of the interest rate cycle should again help us. So overall, I don't believe we should be again in any worse place as compared to where we were.
No, on the contrary, your margins were very good. Last time your domestic NIM was 3.2, I think the highest NIM I have seen in a very long time. Now with interest rates rising, could that be even higher? Because I think your liabilities reset slowly, but you price your loans faster, so margins can still improve?
So I think to some extent it is possible. Let me also say that when we talked about 3.2%, there were some one-offs which were there. So it would be nearer 3.1. But again, I would agree with you that as a general proposition, when interest rates go up, there will be a lag effect which will be there. Any pricing of liabilities, even if it happens, it is going to be selective, possibly in those categories which are interest rate elastic. And there'll be a more secular increase as far as the lending rates go. So I think there is an upside, particularly in the first part of an interest rate cycle normalizing.
Okay, so we can see better margins. Okay, let me now come to your specific Bank of Baroda questions, the big merger, amalgamation that you all have gone through recently. Have you all started harvesting any gains because of that?
So absolutely. I think when the merger was announced, we had a very aggressive program for branch rationalization. As much as 1,300 branches, 15% of the network, that has gone exactly as per plan. And therefore, the savings that we were looking at, and we were looking at about a efficiency of 10,000 crore rupees over a 5-year period, they are flowing in exactly as was projected. So even if you look at the last quarter results, our outgo in terms of rental payments actually has come down. That is because, again, the branch network is much productive, much more rational. Even going ahead in terms of the bank's future, we expect that the bank's touch points are going to be more either digital or again BCs. The number of branches is going to be less as a proportion. So if we presume that interest rates are normalizing, you should see the normal kicker in terms of operating income. The fixed costs again remain muted because the wage revision has already happened. Nothing is likely to change next 3 years, and also fixed costs on account of the branch network don't grow. I think we should be in a reasonable pace in terms of expanding margins.
So cost to income has been falling, but some private banks have even lower cost to income. You can still reduce it?
Absolutely. I think there is room for that. I think the private sector banks have done a great job, and I believe that if over a period of time, a reduction of 3-4 percentage points in the cost to income ratio should be something that we should be targeting.
Okay. Well, just a word more on the cost to income, or rather the costs. Your slippages came down dramatically, in fresh slippages in the quarter gone by, and obviously therefore your provisioning. Can there be still falls? I mean, will credit costs still make gains for the bank in the bottom line?
So if we were to look at, you might say, a trend over the next 1 to 2 years, the answer is yes. I think corporate credit costs had been coming down over a period of time over the last 2 years. To some extent, the impact of that secular change was hidden by the impact of successive waves of COVID not becoming more apparent. There will, of course, be on a quarter-to-quarter basis some elevation that might be there on account of particular accounts. But I think in terms of the trend, there is still room for the credit costs to come down, and largely on a corporate cycle. Why I'm emphasizing is that there still is a bit of a grey area when it comes to the MSMEs. Some of the restructuring that has been done will play out in balance sheets over a period of time. But given the proportion of corporate in the book, any improvement there will outweigh any challenges that might be there in segments like the MSME sector.
So room for margins and room for cost to income as well to come down. I want to take a break on that note, but thereafter are the key questions of the future of banking and the future of Bank of Baroda in terms of the digitalization of the bank. We are back in a minute.
Bank of Baroda presents The Future of Banking, powered by CNBCTV-18. Bank of Baroda presents The Future of Banking, powered by CNBCTV-18.
Welcome back to this special series, The Future of Banking, powered by Bank of Baroda and CNBCTV-18. I have been speaking with Mr. Sanjiv Chadha, Managing Director and CEO of Bank of Baroda. Mr. Chadha, now for that Bob World app of yours, can you tell us what plans you have? How much has it already improved in terms of customer service or margins?
So I think the Bob world, as we have discovered over a period of time, is becoming fundamental to the bank, touching all parts of the bank more than what we might have thought. Firstly, of course, because of COVID, where the adoption has been very rapid. So when we started this financial year, we had about 10 million customers on our mobile app, active customers. This year, we'll end up with 20 million. Now, 20 million is in the context that, for us, YONO has always been a source of inspiration. SBI has about double the number of customers, but with maybe 4 times the number of overall customer base. So it has been a very, very good journey for us. We plan to take this number to about 30 million in another year's time, which will mean that if we look at our non-financial inclusion customers, fully 50% for them, the primary interface is going to be Bob World. Now, that has got tremendous implications for us in terms of both ease of business for our customers, but also for us in terms of new income streams, in terms of costs coming down. Even today, as we speak, 3 times the number of customers who visit 8,200 of our branches come and transact on Bob World. Okay. So the upside is absolutely it's limitless as far as we are concerned. Today, we offer about 235 services on Bob World, which means that when it comes to retail in particular, you can almost do everything excepting operate your locker on the mobile phone app. But it's something which actually the power goes much beyond that. Just like we used to have branches which were specialized, some for NRIs, some for HNIs, some for a rural customer, I believe we should be having different versions of Bob World, which again should be targeting customers and also having an interface which suits them much more. So it's going to be a very powerful impact. The other part again is that you are actually now talking of other than banking services also which are being transacted. So we always talk of Bob World as something which enables saving, investment, yes, borrowing and transactions, and the other pieces are becoming very, very important. It's not that you necessarily have direct monetization, but the kind of data that you generate that has tremendous value for the bank. So I think it is really fundamental to our transformation, but equally true that digital is touching other parts of the bank. Even when we started the journey before Bob World came in, we had the program of trying to make sure that we open almost as many of our accounts as possible through tab banking, because there were advantages by way of standardization of the process, getting your KYC right, ease of customer transactions. And what you found was that there is a digital divide which still persists. So for us, tab banking has now become 95% of our account opening, but because we have assisted digital also, yes, right? Which means that if a customer comes to the branch, the choice is you can operate the machine yourself or have somebody help you out. I think similarly, again, when we look at digital, I think the fact that you have got a combination of interfaces is very valuable for us. To take another example, we talked of business correspondents. Now, all business correspondents work with handheld devices, yes, right? So to that extent, again, assisted digital is touching every part of our client base, including our financial inclusion customers. So Bob World is going to be at the center of the interface. And on one side, we'll be looking at our HNI customers, for whom again there'll be specialized applications, and on the other side, the financial inclusion customers, for whom again the BCs are the interface. So effectively speaking, almost 100% of your customer base is impacted by either Bob World, which will be 50% of the customers, or the balance 50% to assisted digital.
That's amazing. I mean, if you can even get financial inclusion in that context, the fact that now microfinance loans are, qualify even for households of 3 lakh, and of course there are other SOPs thrown in, no interest rate cap. Will you be able to leverage on that and get more into microfinance?
So absolutely. I think one of the great things for BOB, and something of which we are very proud, is that we have a 6% market share in banking. Oh. But our market share in Jan Dhan accounts is 17%. Oh. I don't think there's any bank which has the same proportion in terms of their market share. And to my mind, that is a source of tremendous strength. We talk of in terms of the cost of customer acquisition. So just imagine these 60 million accounts which are there by way of financial inclusion. Today, the average balance is well in excess of 3,000 rupees. And as you said, the moment now you start again rolling out new products which actually are designed for their requirements, I think there's a tremendous upside for the bank. And in terms of future savings on customer acquisition, this is an impact that will play out over very many years.
Oh, absolutely. And you will see them, becoming prosperous, growing, and therefore, they are, a sitting customer for you. What about, using artificial intelligence, machine learning? We see these words getting thrown in, but are you able to use all that? Is there a lot of investment in these kinds of technologies, and is it leading you to sell more efficiently?
So I think if we were to just take a step back, I think we talked of Bob World, but even as we speak, I think almost every area is being impacted in some ways by either AI, ML, or what could be a precursor to that. For instance, again, if you look at customer experience, right? We talked of Bob World, how it impacts it. You look at risk management. Today, again, you actually try to make sure that even when transactions are going through on a real-time basis, you assess them against the behavioral patterns of past transactions by the customer and see whether there's any chance that they may be fraudulent. We're also looking at, again, possibilities where, again, when you actually use Bob World, depending on the kind of pressure you apply when you actually press the screen, we should be able to analyze, again, based upon machine learning, whether it is indeed you who is transacting with somebody else. So I think the possibilities are going to be limitless. Limitless in terms of customer experience, in terms of cost savings, in terms of new income streams which can come on account of cross-selling, in terms of risk management, in terms of governance also. So I think that's where it comes. But again, specifically to your question, we actually have been working with IIT Bombay on very many projects to see how we can use, again, their talents to improve areas, particularly with on the basis of AI ML. So for instance, again, IIT Mumbai is working for us to see how we can actually predict what might be the currency requirements in our ATMs. So based upon AI ML. That again, we're trying to see if we can put sensors in our ATMs, looking at humidity, looking at temperature, to see again how they might impact the performance of ATMs in terms of if things are going wrong, or again how reliable they are. So we are looking at, again, translation. So all banks, again, have departments in terms of translation. Now we are trying to see that how for vocabulary which is really relevant to banks, you can have translation from Indian language into English and vice versa, so you don't have to run a translation department. So a variety of areas that we are working, and to my mind, again, just as we find that digital today is impacting every area of banking, AI ML in very many ways is going to have the same kind of impact over a period of time.
This is fascinating. I mean, I can't imagine that the same digital product you have is servicing the entire range of evolved customers, rich customers, as well as customers who will need it in another language, or perhaps bottom of the pyramid products. So finally, Mr. Chadha, how would you look at Bank of Baroda, say 3 years down the line?
So to my mind, I think the pandemic in so many ways, we always say, has fast forwarded the process. It has also given us a window into the future, right? Now it is for us to make sure that we don't slip back into our old habits. I think that's something which is very important. But in terms of going forward, the digital piece is going to be central. The mobile phone is going to be the primary interface with our customers, and you'll be building the rest of the bank around that interface, which means just like, again, you go to an Apple store to experience a product, right? Or again, if you need any help, but not necessarily to buy a product, that you will almost always do online. To my mind, again, a lot of branches, again, will have to be designed and equipped on that basis. We are, as of now, working on a program to redesign almost all our branches to see how, again, they can correspond to the bank of the future and what customers expect of us. Also, again, as you said, AI ML is something which is going to be impacting every aspect in terms of how we understand customer behavior. So even today, when we are looking at doing car loans, for instance, earlier on we used to, again, just look at, okay, this is your name, this is your job, this is your salary, and on this basis we'll compute what your requirement is. Today you try to see, again, what is the inclination of that customer that you can presume in terms of repayment, and on that basis you actually take a decision whether what is the kind of exposure you might want to take there. So to my mind, that's really what the movement we're looking at. From moving on from historical data, which we always used all these very many years, you're moving to real-time data like GST returns, and from real-time data you'll be looking at future behavioral patterns based upon data which has not yet been generated. That's what possibly AI ML is all about.
Okay, that's fascinating, especially that, as you say, GST returns, that could open up a whole lot of possibilities and probably less risky possibilities for a bank. It was a pleasure speaking with you, Mr. Chadha. All the very best. Thank you very much for joining us.
Thank you, Lata.
Well, that's it on this special show. Thank you very much for joining us. There's more lined up.
Bank of Baroda presents The Future of Banking, powered by CNBC TV 18.